What if the inflation rate, the monetary inflation rate, not the CPI, but what if the money expansion rate was zero? In that case, the currency is also an asset and it's a store of value and a medium of exchange at the same time. That's a complete Austrian economics, like deflationary economy, where we call it hard money or sound money. The closest thing to that would be the gold standard. If the government said you can exchange your money for gold at any time and we'll keep gold equal to the amount of money and we won't print any more money, well, that puts you on a hard money standard. In that case, you could just store your money in a bank and it would be more valuable in the future, not less valuable. When the government goes off the gold standard, and we went off the gold standard explicitly in 1971, now the currency is losing some percent of its purchasing power every year because it's being inflated away. And what's the number? Well, it was about 7% a year, and now it's like 20% a year, and 15 to 20% a year. And you got to figure out, is it 15, 20, or 25? But if it's 15 to 20, the currency is weakening 1 to 2% a month. When it gets to be 40 to 50, it's collapsing. That's Argentina, or worse. So you've either got a country where the currency is weakening or a country where the currency is collapsing. When that happens, now you have a decomposition. The money is broken into two components. You have a currency component, which you use as a legal medium of exchange, like the dollar or the euro or the yen or the renminbi. And then you have an asset component, which you use as a store of value over the long term. Money or U.S. dollars have ceased to be a store of value for at least the past decade, since the great financial crisis. So what people did was they stampeded into ETFs and index funds, right? And to a certain extent, bonds, right? How do you store your value over the long term? Well, if I take money and I buy a mixture of stocks and bonds, that will store my value, because if the economy is healthy, the stocks go up by 10% a year. The S&P does. And if the economy is not healthy, the Fed will lower the interest rates by 50 basis points and the bond will trade up. And so that works for how long? It works, watch the interest rates for the last decade. It works until you crank the interest rates down to zero. It used to be overnight money was 550 basis points, Tom, before the great financial crisis. And then they cranked it down from 550 to 500 to 450 to 400 to 350 to 300 to 250 to 200 to 150 to 100 to 50 to zero. And now we have, the bankers say, I'm not even thinking about raising interest rates. So that breaks bonds as a store of value, unless you go negative interest rates. And stocks work, except for the fact that, what stocks worked in the past decade? Apple, Amazon, Facebook, Google, a big tech company that grows 20% a year top line. When Apple stopped growing 20% a year top line, they fixed it by taking on massive amounts of debt, buying their stock back, and leveraging up their EPS. So companies that grow faster than the rate of monetary inflation, faster than the 7%, they could hold value. A company growing 20% like Google, Facebook, or Amazon, they all hold value. In fact, they accrete value. Why? Because 20 is more than 7, right? So it's plus 13% a year, right? What happens to all the other companies? Which companies in the S&P 500 amounted to all the indexes, or to all the gains? It was big tech, right? Big FANG stocks were the winners. Everybody else treads water, because if you're growing at 7% and the money supply is collapsing at 7%, you're net zero. And how else do you get around it? Well, you can go borrow a lot of money, leverage up, buy back half your stock, and get your cash flow per share up. But what happens when you're fully leveraged, which is like where they are right now? You can't do it anymore. So what's the problem right now? The problem today is the currency is being devalued at 20% a year, not 7% a year, right? I turned up the heat in the frying pan. And the second problem is some stocks could hope to grow 20% a year, like the minority, 5% of them could grow 20% a year for the past decade. What percentage of stocks can grow 30% a year? Because now you got to grow 30 or 35% a year because the hurdle rate just jumped. Now you're pushed out on the risk curve here. You got to take massive risk as a company to grow that fast. You got to do acquisitions. You got to burn the candle on both ends. You got to take on massive new leverage. This is squeezing. Value stocks don't work, right? I mean, it squeezes you out of the value stock trade because if the company is reliable and it's growing its cash flows 5% a year and the money supply is expanding at 20% a year, cash is trash. Back to my story, right? Why is cash trash? Because I had a value stock with a lot of cash and the money supply is expanding. Look at it from the point of view of an investor. They can invest in the S&P 500 index or the NASDAQ, and those were all up like 40% year over year or something, Or they could hold cash and get 0%. Nobody wants to hold cash. And so they might as well just take it and put it into something else. Now, long term, you can get a bump on equities when you have a boost, when interest rates get spiked down. You saw it. When we flood the market with liquidity, initially that makes stocks go up. But let's take the example of Zimbabwe and Argentina. If I keep doing it for 10 years, what happens to those stocks? They don't go up. Right? The problem over time is stocks are valued based upon the discounted value of the cash flows, or at least in part. And so if I give you a company generating $100 million in cash every year for the next decade, but I tell you there'll be 10 times as much money in the economy in a decade, that $100 million of cash will only be worth 1/10 as much in a decade. So the discount rate is jumping, which means the value of the cash flows into the future is collapsing. The road to serfdom is working exponentially harder for a currency growing exponentially weaker. And so how do you solve the problem? And the solution to the problem is you convert your assets from a weak currency that's inflating into a strong currency, or a strong asset, if you will, that is deflating.
Oh, sorry.
Right? The simplest example is I'm a wealthy business person in Argentina, and the peso is trading 3 to the dollar, 3 pesos to the dollar, and the year is 2003. And now I can go forward and I tell you, well, in the year 2020, the peso is going to trade 150 to the dollar on the blue market or the black market. That's going to be the real rate. So what's your best strategy? Work hard, diversify into other Argentine companies making pesos? No. Your best strategy is convert all your existing pesos into dollars and get it out of the country. And your next best strategy is forward finance your cash flows and convert those into dollars, get them out of the country. And your next strategy is sell equity in your ranch or your business in pesos in 2003 at 3 to 1, 3 pesos to the dollar, and then buy dollars because the dollar is going to go up by a factor of 50. So what you're doing is you're financing in a weak currency, and then you're converting into a strong currency. And that's pretty obvious if you lived in Zimbabwe, or if you live, Lebanon went from 150 Lebanese lira to 700, it went from 1,500 to 7,500 overnight.
Whoa.
So it means you lost 80% of your money if you had it in a Lebanese bank. And so the answer, of course, is convert your lira while it's 1,500 to the dollar into dollars before the devaluation. Right? Now, what can you do if you're a modern business person, right? If I can't convert to dollars, the next best thing is buy something tangible that won't lose 80% of its value overnight. Buy a boat, buy land. Traditionally, people bought other tangible assets, gold, right? Something like that. But if you buy an asset which is valued based upon its expected future cash flows that are in that collapsing currency, that doesn't work for you. Like, you could own every good business in Venezuela. How's that going to help you when the Venezuelan currency collapses by a factor of 1 million? It won't. Okay, so what's Bitcoin? Well, Bitcoin is the strongest asset the human race has ever invented. It's like gold with none of the defects of gold.
So define what the defects are. Why is it the greatest monetary invention?
So I buy $1 million of gold. Okay, if the price goes up, the gold miners, first of all, the gold miners are going to create more gold and dump it on the market. If I could eliminate all gold mining forever, if I could wave a magic wand and make it impossible to mine any more gold, my $1 million of gold will hold its value better because it'll be scarce. But gold miners are inflating the value of the supply of gold by at least 2% a year or so. And then if the price doubles again, investors will invest in more gold miners and they'll create more capacity to mine gold. So you'll create capacity to mine gold, you'll mine the gold, you'll crank up the rate at which the gold mines function. After that, people with gold jewelry will melt their jewelry down, convert it to gold bullion and sell it, right? If the price of gold went up by a factor of 20, you would be like converting all your gold stuff into gold bullion because it seems like a good idea. They call it scrap gold, right? And then after that, bankers will issue gold warrants and gold paper and gold derivatives, and they'll sell them short without the gold because they can speculate in it, and they don't have to have a one-for-one coverage of gold to the gold derivatives. And so that's called hypothecation and rehypothecation. Okay, if it keeps going up, the governments holding gold will start to sell some of their gold to manipulate the price down. Right, and all of these, and ultimately, if it goes up enough, someone will club you over the head and take your gold, or a hostile regime will take your gold, or a politician will pass a law taxing your gold. Right, there's a lot of ways you lose gold because it's physical. How do you cure the problem? Right, I mean, here's how you cure the problem. You make it impossible to mine any more gold, and then you make it possible to take custody of your gold personally off of the exchange or off of the bank. So that way the bank can't hypothecate it or rehypothecate it, miners can't inflate it, investors can't create any more gold miners. And then you make it possible to move it from here to Switzerland or Singapore in an hour for a nickel. And that way, if you don't like your bank or don't trust your bank, if the state of New York passes a law taxing it, you move it to the state of Wyoming. You know, if the government passes a law taxing, you know, the ownership of land in California, you can't move the land out of California, can you? If you have $1 million of gold in a bank and in a vault in New York City, you know, there's only a couple of places you can move it. You can move it to London if you have 6 months. Okay, so you're going to be subject to the law of London or the law of New York. Can you actually move to your favorite island, or, you know, can you move to the Cayman Islands and bury your gold underneath your hut in the Cayman Islands and be safe about it? Not likely. Can't even get it through the airport. Right? So the problem with other properties, and gold is the simplest example, but the problem, the challenge or the analogy holds with any property. I give you a bunch of money and I tell you you want to keep it and give it to your grandchild. Do you buy a building in Manhattan? Do you buy a ranch in California? Do you buy a stack of gold bars? Do you buy shares in a company headquartered in San Francisco? Do you buy bonds issued by a government or a company? Or do you buy Bitcoin? And you can see the problem, of course, is the debt is devaluing rapidly. The land in California can be taxed and is not movable. You know, the building in New York is not going anywhere. It might be valuable to a rich person that lives in New York. What about a rich person that lives in Beijing? Do they want your building in New York? How are you going to hide your building, right? Buildings get property taxed. There's a very famous story about, you know, a bunch of luxury, you know, yachts sitting in Sardinian port, and the locals decided that it wasn't fair that all these rich people were sitting on their yachts in the port, spending all this money, but they weren't paying enough taxes. Now, they were putting millions and millions of euros into the economy, but they came up with the idea that they were going to put a tax on the yacht, on the value of the yacht. And so they passed a yacht tax that would have cost people millions or tens of millions of euros if they stayed in that port. and everything was happy, and all the restaurateurs and the hotelers and the entertainment people and the port, they were all happy, making tons of money off the yachts until the day before the tax went into place. And the morning that the tax went into place, the port was empty and the economy died. Everybody left because yachts are floating capital. It just moves. It's floating property, right? So it's a very visible example, right? Why it's not that smart to put an unfair tax or an extreme tax on a yacht if people can float the yacht to the next port, 100 miles to the left. So one would be discouraged from taxing stuff that floats. On the other hand, taxing a building that's buried, 100 feet down in the bedrock, that's easier. You can't move the building. So Bitcoin represents the apex property rights of the human race. Like I'm not disputing the ability or the, legitimacy of a government to pass a tax. At the end of the day, they can tax your gold, they can tax your stocks, your bonds, your building, yourself, your income, whatever they want. But the point really is you're a lot more likely to tax the stuff that you walk past, every day on the way to work. And legitimately, you can move yourself and you can move your property, if it's crypto, to another jurisdiction, but you can't legitimately move a ranch in California. So your property rights are stronger and the value of the property is higher. Right? You have a valuable thing in Manhattan. It's interesting to other wealthy people in Manhattan, but when you have Bitcoin, it's interesting to wealthy people everywhere on Earth. Right? You can liquidate $1 billion of Bitcoin on the weekend in any currency, any time. Try liquidating $1 billion building, right? That's a 3-year process, right? So it's liquid, it's fungible, it's desirable, and so that's what makes the asset valuable. And it's the most difficult thing to impair. Tom, once I had $1 million seized by the Argentine government. Here's how it happened. I had $1 million in a bank in Argentina in dollars, and it was a U.S. bank. On one day, they simply passed a law converting it all to pesos, and they converted everybody's account to pesos in the country. And the next day, they devalued the peso 10-1. And 24 hours after they'd done that, I had 100,000, whereas I had $1 million before.
Ooh. And
they did it. They did it quickly and easily to everybody in the country. Now, in theory, if it had been property, they would have had to pass a law seizing 90% of the property of everybody in the country. That would not be so popular, right? To seize the property. And if they wanted to seize 90% of the property of everything in the country, they would have had to subpoena a court in New York or Delaware and get my appearance, right? And there would have been 3, 4, 5 years of lawsuits going on. And if you really wanted to take something, you have to kidnap everybody and take them to jail and sweat their private keys out of them. And that's not very practical, right? So at the end of the day, it's not likely that the governments of all the world will just confiscate 90% of your crypto assets or your Bitcoin. But in fact, it's a foregone conclusion that they're definitely going to compensate 90% of your currency. Right? It's happening at 1% a month or 2% a month right now. So all you got to do is wait between 5 and 10 years, and you're going to lose 90% of your of your money if it's in a currency or a currency derivative. And they don't even have to pass a law.